The Canadian dollar is continuing its ascent against the greenback. This is following Tiff Macklem's hawkish commentary yesterday. The Bank of Canada governor said the policy rate will need to rise further as inflation remains high and broad-based. Our next guest expects more upside for the loonie. Let's bring in Karl Schamotta. He's chief market strategist at Corpay. Thanks, Karl, for being with us. Two things, I guess, are happening at once that are affecting the cross. While the BOC kind of remains that rates need to go higher, the Fed minutes from the U.S. suggest we will probably need to go higher, but we'll get there slower.
Right. So, if you read through the minutes from the last Fed meeting, what they're really articulating here is that they are looking at a more cautious approach in the months ahead and a more data-dependent footing, right? So very, very clear in a number of the sort of subsections within the minutes that Fed policymakers are starting to get a little worried about the downside risks of over tightening. They're starting to think about, whether those rapid movements earlier in the year are now having downside effects on the U.S. economy. And so that's a very different tone than we heard from Macklem yesterday. Macklem was essentially saying that, rates do need to go higher, that we are seeing continued signs of tightness in the Canadian economy, whether you look at wages, whether you look at the employment market, you look at overall consumption. The fact is that the Canadian economy is still running on all cylinders. And that suggests that that policy does need to go a little bit tighter than it is right now.
And would you say that's the driving force right now for the Canadian dollars is where interest rates are? And I ask that because oil prices have rolled over. They're down at 2-month lows. Even worse, if you're looking at Canadian oil prices, and the CAD, which typically tracks that, seems to have decoupled.
That's right. It decoupled, I think, about a year and a half ago. I like to kind of joke that the Canadian dollar has gotten in touch with its sensitive side. At the end of the day,
that's a good one. I like it.
The reality is, though, that right now we've got a Canadian economy that is very sensitive to changes in the global economy, to changes in global risk appetite. And so the correlation between the S&P 500 and the Canadian dollar is far stronger than with oil. And it has been for months. And so that really reflects that.
In fact, the bottoming of the CAD kind of coincides with the bottoming of the TSX and the S&P.
Exactly. And so really what you're seeing here is that global foreign exchange traders are concerned about those risks in the Canadian economy. They're thinking about how much leverage Canadian households are taking into what is, potentially a downturn next year. How much leverage is going to sort of be exacerbated by this rise in interest rates, and so they're looking for a downturn in the Canadian economy and in Australia and economies like that, while those more stable big economies like the Euro area, the UK, start to outperform the US. So the interesting, complex situation in the global currency markets right now is that those big, stable economies are starting to outperform relative to the dollar. The dollar looks like it peaked potentially, back in September, while, at the same time, we have those high beta sensitive currencies like the Canadian dollar, the Australian dollar that are weakening off.
Well, they're weakening off, but as I mentioned, they've been strengthening recently. So do you think that's sustainable?
Yes. I do think that, we have some ground to make up, that the sell-off earlier this year was overdone. But, if we look at where the dollar's headed,
the U.S. dollar.
The U.S. dollar, yeah. The big question here is how overvalued it is at this point, right? We've seen this massive rally on the back of safe haven buying, on the back of geopolitical shocks, on a terms of trade shock from the commodity side, and on the Fed tightening very rapidly. And all of those drivers are fading into the background now. Yeah. All of those are looking more stable in the year ahead. And so I think traders, especially going into year end, are going to look for any other opportunity. They're going to look for anything that they can do to get outside the dollar and look for yield elsewhere.
What do you think the final rate or the fair value is for the Canadian dollar?
I'd say we're going to end around 76 cents by year end, which is slightly up from where we are today. But, early new year, we could be looking at a world of pain for the Canadian dollar and for the Canadian economy.
A world of pain? What does that mean?
I think we are looking at a downturn in Canada, definitely worse than I think we are seeing in consensus pricing. The Bank of Canada is likely to stop hiking, perhaps in December, perhaps one more meeting after that point. And that is in response to what we're going to see in the economy itself. And so, we think that Canadian consumers are going to quit spending at the levels that they have been, that we are going to see continued weakness in the housing market, and the overall economy is going to slow quite dramatically.
So if I hear your call right, it's you could get a temporary, upswing in Canadian dollar, but look out for next year. How low are you talking?
I think we could be back around the 73, even lower at some point next year. And, certainly by the end of next year, we could see things converge. We could see the Canadian dollar rally back up. But the reality is that the fundamentals in the Canadian economy do not support a high valuation for the loonie at this point.